So you want to search the markets for reputable firms. Of course, AIER has a branch of its investments. A branch of it is AIS. Is somebody going to talk about that at all briefly, Walker, tonight or not?
I don't think they're in the room.
All right, well, they have an investment arm. I'm not an employee of AIER. But they have an investment arm that gives good advice. I would listen to them. I would listen to Vanguard. That's about it. No, there's a lot of reputable long-term funds that talk about being highly diversified, tax-efficient, transaction cost fee investing, and just spread out the money as much as you can with those types of funds.
Has any fund company or anyone put together a quote market portfolio ETF or something that approximates your little bit of everything according to its size? If this is, based on this theory, is there anything that comes close, or you have to go pick these individual asset classes and try to get the right mix?
Well, let me give you a yes and no answer. By the way, most of them invest in proportion to its size. All these indexers do that. So this part is done. The problem is, are they putting all risky assets in there? And we keep moving closer to it. 2-3 years ago, it seemed like you just had to put, one of them would be U.S. and one of them would be international. Now they're getting to both U.S. and international, but it's still just stocks. Now when I say stocks includes real estate, because there's real estate investment trusts and corporations own real estate, so real estate's in there. But there's other asset possibilities like commodities. Well, when you buy Alcoa, you're buying into aluminum. So there's some commodity exposure there. But I think in the next 5 to 10 years, we're going to see portfolios that go beyond an equity view, and they start, like right now, it's usually stocks or bonds. But I think we're going to increasingly see ETFs and open-end funds that have everything in there. Emerging markets, developed countries, U.S., debt, equity, real assets like commodities, infrastructure, hedge funds. I think we're moving in that direction.
But that doesn't exist now?
I don't think so. Anybody know? I haven't seen it. I do see us getting closer.
I think Vanguard's introduced a total global market fund, so now you can do it with one. I don't remember the ticker, but I think it's VTV.
But that's stocks, right?
But that's stocks.
That's just stocks, right? But someday we're going to have it where it's going to have bonds in there, and we're going to start to get some alternative assets in there, and I think that's where we're headed. It's where the future is.
Are you going to discuss the role of bonds?
Well, actually, when I say all risky assets, and I know I've been talking stocks, I actually also mean risky bonds in there. So this is going to include long-term corporate bonds of good quality, junk debt, the high-yield debt, that should also include those. If junk bonds represent 4% of the stock, 4% of the whole investment universe, then you ought to have 4% of your money in junk bonds. Now, when I say your money, once again, what I mean is of the portion that you're going to put into risky assets, you want the percentage that you put into each type of risky asset to be proportional to its size. If junk bonds represent 4% of the risky universe, you should put 4% of your money in junk bonds. So how much should you put into emerging market stock, emerging markets debt, developed countries stock and net debt, U.S. stock and debt, junk debt? You should do it in proportion to their size. All of these assets. I've talked about stocks too much. Every time I should have said stocks, I should have been also saying corporate bonds, junk bonds, agency securities, everything. Everything that contains risk. If it's tax appropriate, if it's competitively traded, and if you can buy it without bad transactions costs. So would I say get involved in hedge funds? No. I wouldn't get involved in hedge funds. It'd be a very sophisticated investor to get involved in hedge funds at this point. Charlie?
Do you know of a publication in which it sort of gives the market shares of these different risky assets?
Not off the top of my head. I frequently surf for these things.
Would you be willing to write one for us so maybe the people that come would have some?
I'm working on a series that may be published by AIER on these concepts right here. And I think a good follow-up to that would be what this portfolio tells you to invest in. And where are the cost-effective places that you can get those exposures? That's a great question.
So stay tuned.
So I may get voted off the island for saying this, but so you made a point a few minutes ago about you sort of think that it might be reasonable to get away from this theory and invest more in your home country as a. But to me, I would think that if you're going to get away from the theory, you want to do exactly the opposite. If I work for Apple, I don't want to own Apple stock because if Steve Jobs dies and the company goes under, I lost my job. And then, now I've lost all my investments. So I would think that the rational thing to do would be to look at this and say, I want to invest even less than 35% in the United States because if something goes wrong, I want to be protected. I'm already going to be surrounded by misery and depression around me. Why wouldn't I want to protect myself by being more international? So that's why I sort of, I don't really understand what you were saying.
Well, it's a good point you're making. And I'd say that myself, I plan on spending the rest of my life in the U.S. and kind of rise and fall with that ship. But you're absolutely right. My human capital is tied to the U.S. If the U.S. economy goes well, I'm going to have great job prospects. If the U.S. economy goes down the tubes, I'm going to have bad job prospects. You can think about that in a countrywide context, or I'll tell you briefly about my dad. I'm from Corning, New York. Walker said upstate New York, Corning, New York, which is where Corning Glass is. Of course, my dad worked at Corning Glass. His job was with Corning Glass. His retirement program was with Corning Glass. The real estate that he owned in Corning went up and down with Corning Glass. Just terrible diversification. So what's the last thing that he should have been speculating in? Corning Glass. What was he speculating in? Corning Glass. Of course, it was $100 a share, and after it crashed from the bubble, it went down to $20 a share. We know that anything that goes from 100 down to 20 is going to go back up, right? So we bought it at 20. Its low was almost $1 a share. So yeah, you could argue this either way in terms of being U.S.-centric, home-based, or as you're talking about, very rationally and very clinically, diversifying and saying I've already got my human capital in the U.S., I should put 80% abroad. That would be a perfectly rational answer as well. This is why this is a behavioral issue. It's how you personally can psychologically adjust to those positions. And I think you articulated a great answer there.
Yeah, I would a quick follow-up on that. What if it were scientifically proven that every 10 years foreign debt defaults? Would you stick to that recommendation? I mean, the argument traditionally has been not everybody defaults simultaneously every 10 years, although that did happen in 1982. But while a case can certainly be made for holding non-U.S. assets, isn't there an argument to be made for as long as you're living here and you've got to pay your bills in dollars, and people aren't going to ask for Thai baht or Singapore ringgit or whatever, that you'd better make sure you have enough dollar income coming in retirement to pay your bills?
Well, one thing is this idea of diversifying into everything means that you're going to be part of every good return and you're also going to be part of every bad return. So would I invest in sovereign bonds, the nations or corporate bonds in other countries? I think you mean sovereign bonds. If they defaulted once every 10 years, if I believe that pattern is going to be repeated, well, it would have to give me a yield of, if it gave me a yield of 20%, that would be yes. And
Well, you can get 12 or 14.
if it defaults every 10 years, that's probably not good enough. But if it had a high enough yield, I want a piece of every action. I want to diversify.